if you're not familiar with us and with MyHR Concierge, we work with companies in all industries, but we do a lot of work in the independent grocery industry, and we work with clients from 5 employees to 1,200 employees in most states of the union, providing human resource services. Primarily, what we do is provide that additional level of workforce compliance assistance, as well as, our goal is to get you guys as management as much out of that as we can, so that you can focus on other things. But we will, we work with human resource outsourcing services. They're very flexible, so that we can meet your needs, as well as, we reduce your risk associated with that employee management. And we provide guidance on new laws and regulations, kind of like what we're doing here today. As well as the Affordable Care Act, we help with consultation to make sure that you stay compliant, as well as we have resources and systems that can help you with your monthly calculations and preparing your 1095 and 1094 forms, as well as other services such as background checks and drug testing. So we're pretty much a full-service HR company, and we've worked with FMS for several years now, and it's been a great relationship, and we do appreciate the opportunity to speak with you guys today. And today what we're going to talk about, we'll talk about the new requirements. We'll talk about why it's important. So what's the effect of the new requirements? And then we'll talk a little bit about what do we do now? So how do we try to mitigate, and what do we see maybe in the industry as how other companies are approaching this change as well. The big thing, and what I want to make sure that everybody knows, is that the effective date for this law change is December 1st, 2016. We were somewhat fortunate. Originally, the thought was that this would go into effect in August or September, but they did provide a 5 or 6 month leeway for businesses to get ready for this change. So this does go into effect at December 1, but I do want to caution everybody, we can't wait till November 30th to start thinking about it and to start working on how we're going to affect it. Other thing I want to point out as we get going, as we kind of get started, and these are always questions that I get, and I want to make sure that as we start and we're talking about these things that we do address them. Just because an employee is salaried does not mean they are exempt from overtime. I know I have a lot of conversations with clients, and we start talking about whether somebody should get overtime or not, and the first thing that's always said is they're salaried, so they don't get overtime. Just because someone is salaried, that has no bearing on whether they get overtime or not. So we need to keep that in mind. And in order to determine if they are exempt from overtime, they have to meet the salary level thresholds, which we'll talk about in a minute, as well as the exemption test to be exempt from overtime. You'll see that the new salary level threshold is roughly $47,000. Just because somebody makes over $47,000 does not mean they automatically are exempt from overtime. They still have to meet the exemption tests. So I want to make sure that we kind of make that clear as we go forward, because I know that's always some confusion. The exemption tests, and we won't go into these in great detail, but the exemption test, there were no changes. So there's nothing that will be new on December 1st that is different than it is today. But there are roughly 5 exemption tests. There's an executive exemption, administrative exemption, a professional exemption, a computer employee exemption, and an outside sales exemption. I'll go real briefly. There are few more idiosyncrasies to these, but at a very high level, I'll primarily talk about the executive and the administrative exemptions, because those are the ones that most people try to use when they're saying that someone's exempt from overtime. The executive exemption, effectively, they have to meet the salary threshold, which we'll talk about in a minute, but also they have to have the primary duty of managing the enterprise or customarily recognized department or subdivision of the enterprise. So they have to essentially run either the company or a department therein, or a subdivision. Also, they have to direct the work of at least 2 or more other full-time employees or their equivalents. We see a lot of times where we have a, quote, supervisor that manages one person. If they're only managing one person, that they don't meet the exemption test. It has to be at least 2 or more. Also, what they have to do is they have to have the authority to hire and fire, or their suggestions and recommendations as to the hiring and firing, etc., of their employees must be given particular weight. So effectively, they either have to be able to hire or fire, or their input has to be weighed into the decision to hire and fire employees. So that's an executive exemption. The administrative exemption is, again, they have to meet the salary threshold, but they also have to have the primary duty of performing an office or non-manual work directly related to the management of the business. And their primary duties have to include using discretion and independent judgment with respect to the matters of significance. So they have to be non-manual, and their work has to directly be related to the management of the business. Okay. Now, one thing I want to go back to the executive just to make one statement too. In addition to those things that we talked about, the person's primary duty has to be managing, not production. Okay. So if you have a meat department and your meat department manager cuts meat 70% of the time and manages people 30% of the time, then they're not going to meet that executive exemption. So their primary duty has to be that of managing and not actually doing the work. So those are the executive and the administrative exemption. Just real briefly, the professional exemption, that's basically when you have someone that is doing work that's predominantly intellectual, which includes requiring the consistent exercise of discretion and judgment. They have to have an advanced knowledge in the field of science or learning, and they must have an advanced knowledge that has to be required through a prolonged course of specialized intellectual instruction. Otherwise, they have to have taken courses or education, schooling, college, whatever that may be, to get an advanced knowledge. The other one, outside sales, I often get a question on that. The employee's primary duty must be to make sales, and it must be obtaining orders or contracts outside the facilities or away from the facilities. So this is generally an outside salesman. There are a lot of lawsuits about that exemption, so that's something you want to be very careful about, but there is an exemption for that there as well. So again, real briefly, those are the exemptions. To be exempt from overtime, you have to meet one of these as well as the salary tests. Now, the salary test, this is where a lot of the requirements changed. The first one is the salary level increased from $23,660 a week to, annually, to $47,476 annually. Okay, and you'll see it's from $455 a week to $913 a week. Okay, so it more than doubled. So that's obviously a big increase. Also, now one thing they did do this time, which is new, is they are allowing bonuses, incentives, and commissions to be included in that calculation. Now, only 10% of that salary threshold, only 10% of the $47,476 can come from these bonuses and incentives, and we're going to talk about that a little more in depth since that is new here in just a minute. Also, what they're doing is they're increasing the exempt highly compensated employees from $100,000 to $134,004. And then another thing that's new, historically what's happened is we have these requirements and somebody proactively has to come in and change them. They're not an automatic update. Well, what they've done here, and this has been very normal, this is what this administration's been doing. If you follow the Affordable Care Act and different changes that they've made to different laws, they've tried to put in automatic updates in all of these, whether it be the way the penalties are calculated with the ACA or whatever it may be. They've tried to have it to where they automatically update. So now, every 3 years, this threshold, the $47,476, is going to be updated. Okay, so we'll need to make sure that we are aware of that. Originally, the thought was they were going to change it to where it would be updated every year, so they did give us a break, and it's only going to be updated every 3 years going forward. So that's a little different as well. So bonuses, incentives, and commissions. Again, this is a new where they're allowing us to use this, which is great because it does. If you do have incentive plans, it does help meet that threshold. Now, there's some caveats. Okay, one, the plans must be non-discretionary, so there has to be a calculation behind the amount that you are providing. It can't be that at the end of the quarter that we decide to give Joe $500 because he was a good guy this quarter. There has to be a calculation behind it. The bonuses can only make up 10% of the salary threshold. Okay, so if you have, if you give them large bonuses, the whole bonus cannot be included. It's only 10%. Only 10% of the threshold can be used, and we'll go through an example. And also, the bonuses must be paid quarterly to be used in this fashion. So if you have an annual bonus, you can't use that against the salary threshold. Okay, so it must be paid at least quarterly. Now, so here's an example, and I think this is fairly telling. So we have an employee A, and they're exempt, and they're paid weekly for the first quarter of the year, and they're paid $821.70 a week. That's 90% of the weekly threshold of $913. Okay, and the rest of that $91.30 theoretically is going to be paid through these non-discretionary bonuses and incentive payments. Okay, these quarterly payments. So every week we're giving that person $821.70. At the end of the quarter, if the employee has not made the equivalent of the $91.30 per week in bonuses and non-discretionary bonuses, the employer has to make up that difference in order for them to remain non-exempt. Okay, so at the end of the quarter, we'll do real easy math here. So at the end of the quarter, that's 12 weeks. So we're looking at 91.3 times 12. He would have had to roughly get a incentive check for the quarter. Now that could be paid monthly or it could be paid quarterly, but no more than quarterly, of $1,095.60 roughly. So if he didn't get that amount in incentive, then what you can do is the government says, well, you can make that up. So the employer has one additional pay period to make up that difference. So in the first pay period following the end of the quarter, if they fell short of that averaging that $913 per week because their bonuses didn't make up the difference, then you can make one payment to catch them up. Now, at some point, is that really an incentive if it's guaranteed? Because effectively, to keep their exempt status, they're effectively going to be guaranteed that $91.30 per week incentive. But it is what it is. So again, just to kind of summarize, employees must make at least $821.70 per week. If for whatever reason the incentives do not make up the difference between the $821.70 and the $913, at the end of the quarter you can make one payment that has to be done in the first payroll following the end of the quarter to make up that difference. And I know that's kind of convoluted, but effectively that's the way it is, and that's the way that works. So there is, if you do have those bonus plans, that is a way to help make up that difference to where maybe if someone is making under that $913 per week, but they have to make at least $821.70. All right, so now we're talking about exempt versus non-exempt. And obviously, to be exempt, there are advantages. One, you must be paid a full week for any week they work. So if you're exempt, if If you're working in a week and you take off Friday, you get paid for Friday. If you only get deductions for full day absences or for sickness. So if someone leaves at 3 o'clock in the afternoon because they have a cold, they're going to get paid for the day. Or if they go see their child go play a baseball game for during the afternoon, typically they're going to get paid for that time because they're exempt. A non-exempt employee, they're really paid for what they work, assuming they're hourly, which most non-exempt employees are hourly. So even though they are now getting overtime, they aren't getting the perks that come with being exempt. Also now what happens is those times that they have in the past taken off and been paid for, now they're not going to be paid for. So, there's give and take to this, and it's not all bad for the employer if you're looking at what you have to pay those employees by making them non-exempt. So what's the effects of this, and why do people care? Well, according to the Department of Labor, the direct annualized employer cost is going to be somewhere around $250 million. So that's a lot of money. So $250 million is an increase in wages due to this change, and they expect roughly 4.6 million workers are going to go from exempt to non-exempt. And they estimate that when you look at all the costs, whether that be overtime, whether that be people getting raises, new employees getting hired because you're trying to level out the work where individuals aren't getting paid overtime, whatever that may be, they anticipate the cost to employers to be about $12 billion over the next 10 years. So it's going to be they're anticipating a large effect. Now, there are ways to mitigate this, and just as it has always been, just as it was with the Affordable Care Act, just as it will be with this, there are ways to mitigate it, and businesses will react. And whether it has that large of an effect as they're stating here or not, I don't know. I anticipate it won't. But this is what the Department of Labor is estimating and what they're projecting these changes to cost employers. Because if you look at an individual that's making $15 an hour, and I know a lot of what we see in your industry is that individuals will work. You may have an assistant manager. They make, I'll just throw a number out, $31,200 in a year, and they work 50 hours a week. And that's just the way it is today. And they're exempt, and they're not getting overtime. So today the cost is $31,200. The new cost, when you factor in, if we don't change their rates and we're just moving forward as it is today, once they start getting overtime, that cost is going to increase to $42,900, which is about a 38% increase in wages, which I don't know of any company that can absorb a 38% increase, right? So what's going to happen is we're going to have to mitigate this cost. So that leads us to what should we do? So what do we do now? How do we mitigate it? And we've talked to a lot of people, as you can imagine. These changes came out, or they've been contemplating these for over a year now. And as we've been speaking with business owners, and so what do we do? And how do we do it to where it doesn't hurt the morale of our workforce? Well, the first thing we got to do is we got to figure out what's the impact. So we need to figure out how many employees do we have that make between $23,660 and $47,476 annually, because that's really the group it affects, and that's the group that we've got to figure out how to address. So we can address it several ways, right? If somebody's making $46,000 a year, what we may do is we may just say, we're going to raise them to $47,500. We're going to get them out of overtime. They meet the exemption tests. We're not going to pay them overtime. We're going to keep working 45 to 50 hours a week, but we're going to give them a $1,500 raise to get them over the threshold. We could hire additional employees. So if you have employees that are working 50 hours a week, what you may do is bring in employees that can work those hours and keep everybody under the overtime limits. Okay, so you do have some increased costs because you know, you're having to pay for those hours, albeit in that model you're not paying the overtime. You can stay status quo, it is what it is, and you start paying them overtime, or you can reduce their pay rates. And we'll talk about all these things in a minute, but effectively in that scenario, what you're going to do is you're going to figure out a pay rate that matches the hours with the annual salary and factor in overtime and figure out what that pay rate should be. Then once we figure all this out and we know what it's going to cost us, we got to budget it, because what we can't do is roll into December and all of a sudden figure out that we've got $10,000 in wages that we didn't have in November because now we're having to pay overtime. So we got to make sure that we're going to have to budget for that as well. So, you know, some of the questions, and we start talking about this, is so what do we do with these new non-exempt employees? You know, we're going to talk about the pay, but also, you know, the other common question is, well, are they salaried or are they hourly? Again, as we talked about in the beginning, just because somebody's salary doesn't mean that you don't have to pay them overtime. So, you know, what we see, what we suggest, and what we see is that most people are changing them to hourly, because that, in effect, is what they are. You know, they're going to have to be paid overtime. You know, there are some downsides to that. One, you know, if you're salaried versus hourly, there's a perceived demotion. You know, there's you know, people are deemed, if they're salary, they are that's above an hourly employee. So there's a perceived demotion. Does it create a morale issue? And so we also have to think about, you know, future escalations as well as when we're deciding this. And we've seen that. And as we've talked to a lot of business owners, you know, they talk about when they tell somebody that, hey, you're now going hourly, there's not a smile on the face. There's a big frown on that employee's face, because the first thing they do is they're saying, why am I being demoted? Also, what we need to do is for these employees, whether they are salaried or hourly, we need to track their hours, because if they, you know, if we're going to have to pay them overtime, they need to start punching a clock, because you're going to have to prove, if the Department of Labor ever comes in, how many hours they work to determine if they should have been paid overtime and if you paid that correctly. What I would suggest is let's go ahead today, and those employees, you know, if they're under the threshold, just to have them, regardless if you make them salary or hourly, make them start punching the clock. What that's going to do is that's going to let you see, you know, we have these managers that work, quote, 50 hours a week, and that's just what they're scheduled and what they work. What that's going to allow you to do is determine, are they really? You know, some of them may be hanging around more and they're working 55 hours. Some of them may be scooting out a little early and they're only working 45. So what that does is allow you to start really building to understand what kind of hours they work. And as you're building your financial model and trying to figure out how you're going to handle this, it at least gives you the hours from which, you know, that these employees work, so that you can use that in your model. So I would have everybody start punching a clock. And again, it's perceived as a demotion, but it is what it is, and it's a little different regulatory environment today. So then the question is if we're going to change them to hourly, how are we going to calculate their pay rates? We can do it a couple ways. We can take their hourly, their wage, their salary, and divide it by 2,080 hours, and that's their rate. So again, in that example above, $31,200, which is what they make today, that's $15 an hour. So we're going to divide their salary by 2,080 hours, and we're going to pay them $15 an hour. Now, obviously, the other side to that is when we pay that overtime, obviously they're going to make a lot more than $31,200. The other way to do it is to say, we know you work 50 hours a week. It's what you're scheduled. We can verify that. We can start verifying that by the amount of time that, by tracking their hours today, so you can make these informed decisions. But we can factor in that anticipated overtime and anticipated overtime hours and use that number when calculating the hourly rate. So in that scenario, if you look at it in that same scenario, for somebody that's making $31,200, they're working 50 hours a week. In order to calculate a hourly rate, even with the overtime, is going to keep them at the $31,200. We're going to have to reduce their hourly rate from $15 to $11, right? And that's a hard conversation, and I've talked to business owners that have had that conversation. Because even though you walk in there and you say, you're not going to make any less money. You're still going to make your $31,200 a year, but your hourly rate's going to be $11. They know, they can do the math, that they're currently making the equivalent of 15 today. And they're going to, again, perceive that as a demotion and perceive that as something that hurts them. Again, you know, I don't know how you stop that, because that's going to be an emotional reaction. Obviously, we want to make sure, and we'll talk about communication in a minute. Obviously, we can give them those facts, but that's going to be a hard discussion. But that's what we see most employers doing, is they change them to hourly. They factor in that overtime, that anticipated overtime, and that's the hourly rate that they're going to get. And what that does is theoretically the economic, you're not going to have the economic increase or the wage increase for that. So that's what we see most companies doing. You know, other things to look at. Do you need to change your schedule? Maybe you need your staffing model needs to be changed, where those assistant managers aren't staying so long, or those managers aren't staying so long. You supplement them with either additional assistant managers, or maybe you have some of your department heads kind of fill in to reduce those hours. If you are factoring in that overtime in that rate, as we just talked about, from a staffing perspective, you can stay kind of status quo, because you're taking the economic impact of that change out of that person's salary, out of that person's wage, because we're effectively creating an hourly rate that gets them to the same annual as they are today. And in some cases, you may want to add additional employees, again, to kind of spread those hours around. So then the question is, one thing we've talked about is, I don't know that we've talked about anything today that's going to make an employee jump up and down and be happy, right? We're talking about changing hourly rates. We're talking about going from salary to hourly. We're talking about these things, and so all those are going to be tough discussions. And so one thing that we have to do is be very proactive and make sure that we effectively manage that transition, and we do that through communication. A lot of these guys, I don't know how much you've discussed this with your employees, but a lot of employees, they all read the paper. They hear all the rhetoric from the campaigns and those things, and they know this is coming. And so a lot of them are happy because they haven't even thought about the fact that you could basically reduce their hourly rate versus them getting the additional overtime dollars. Okay, so in their mind, that $31,200 person is going to make that overtime over and above that. So they're happy. You have others that are anxious or scared because they're smart enough to know there's only so much money in the bucket. There's only so much money that's in the bank account. And so if everybody's getting more overtime, that either means it's going to greatly affect the business, and so are they going to have to lay people off, or how is it going to affect my salary or my pay? So you probably got two ends of the spectrum there, and it's important that we properly communicate to both of those. So really, the message is what you're going to decide to do. It could be that you are going to stay status quo and absorb it, which I don't know of any employer that's doing that. It could be that you're going to end up laying off people. It could be you're reducing hours. It could be that you're changing status from salary to hourly. It could be that you're changing pay rates. There's a lot of things that could be happening there, and you got to make sure that you have that message and really have it honed in. and I would make sure that you're communicating that. You can communicate that either one-on-one or in a group. My suggestion is always do it one-on-one if you can. I was told early on in my career, I was told by one of my, I guess, mentors, a guy who's extremely intelligent, very, very successful. No matter, it doesn't matter how smart you are, you can never debate with a crowd. So in these situations that are negative, if you get in with a group of 20 employees, and I don't know how many this will affect at your operation, but you get in with a group of 10, 15, 20 employees, you know, collectively they're going to be smarter than you are, and they're going to ask questions that you never thought of. And so and all of them are going to be a little bit different, and there's no way that you can ever answer all of their questions or answer the question that's specifically for them. So, you know, my suggestion is, you know, just have them one-on-one where you have somebody in, you sit down, you go through what's going on in the landscape, you know, the new overtime law, explain to them the economic issues with that as far as the increase in overtime, and this is how the company is going to deal with it. And this is how it affects you or doesn't affect you. And so I would do that, and I would do that, you know, as far ahead as you can. I would not wait until December to have that conversation. I would get your facts, you know, track those salary hours, make sure that you can, you know what kind of economic impact this is going to be, formulate your plan, and at that point, you know, have that conversation with your employees, because that's going to be very important in how that's communicated. Also, what you'll need to do is, as we think through this, a lot of times your job descriptions, you will have FLSA status statements, so you'll state whether it's exempt or non-exempt. So you want to go back through those job descriptions and make sure that they properly reflect which ones are exempt or non-exempt. So I do suggest that, as well as your employee handbooks. A lot of times there are definitions there of exempt and non-exempt employees, and just make sure that they are consistent with you know, with the new law. And so, you know, any other documents that you may have that specifically outline exempt, non-exempt, and those statuses. And that's just kind of making sure that you're keeping all those documents clean and up to date. So the big thing is let's make sure that we're proactive with this. Let's not wait till December. Let's don't let this catch us unaware where we're sitting in December and we have $10,000 more in expense that we're not anticipating. Also, I think this is a great time if you are unsure or if you have been inconsistent with the way that you have determined exempt versus non-exempt, specifically as it relates to those exemption tests and those things. This is a good time to clean that up and to do it in a manner where it doesn't call attention to the fact that somebody may or may not have been misclassed unintentionally. So I would definitely, you know, take this opportunity to look at all of that and to, you know, make those changes now if any changes need to be made. And that is the presentation. That's what I have today. My information's on the screen. If you do have questions, you're welcome to give me a call. You can email me, or if you go to our website, we even have chat, so you can chat with me as well.